Hey folks, welcome to Friday, the 28th of January 2022. Just turning around 18 minutes past 10 here in Dublin. Had a bit of a power outage this morning in the home office here, so all good now. What we've had this morning, weak GDP data out of Germany. 1.4 was the reading for the year on year Q4 for 2021 Q4, coming out 1.4% below expectation 1.8 prior 2.8. So we have seen softness in the DAX this morning from that. Little bit of a bid on the initial figure, but really just a nice spot for people to get in on the shorts there, and we're fresh lows on the day in the Nasdaq or in the DAX. Coming through to we've had service sentiment out of the Eurozone as well at 10 a.m. Coming in on a miss across the board on services and industrial. 9.1 services on an expectation 10.3, and the industrial sentiment a miss 13.9 below expectation 15s. But what's more important today is the set of data at half one coming out of the US core PCE price index. Year on year set to come out 4.8%, month on month 0.5. Those figures are going to be the this core PCE price index month on month coming out at 0.5, in line with prior for December, and then the price index year on year for December 4.8, coming out just a percentile beat, 4.8 above the prior 4.7. So if we do get a miss on these figures, that's actually going to be really a good sign in a way, I think, for these markets. But we're going to be going through this a lot more so in the Discord coming into this figure in the team room. So really, the main one the Fed is going to look at, though, is the PCE price index, also known as the price deflator, and that's going to be the more interesting figure. There's no guidance on these. The year on year for December set to really probably be a beat on the prior 5.7. So as we go over and look at these charts, we are really in a tight range here. It is looking like these markets do want a bit more downside, though, and that's pretty fair to say, especially when we look at the Dow now. So crossing over onto these charts, and we'll look at the Dow on the daily first of all. Here, and you can see it's clear as day that we're giving it up on this trend that we've been in. We have a similar trend channel up that we've departed a couple of weeks ago now in the Nasdaq. But the market, you can see here, it's just not able to do anything up here at all in terms of recovery. And so we can talk about this also when we go to oil, but really this is looking quite weak. Resistance on the 200 EMA from today's trade. In the center right of your chart, you see the 60-minute, and that is kind of coming in just around pivot, just above pivot here. So we're weak. We're going to be coming down to see what buyers there are on 33,800s. We'll call it just down here, but they're pretty much walloped these past 2 days here. So are they going to be there again? I don't think so. I really don't think so. This is a dip that is starting to taste a bit sour, really, and for good reason. We're flushing out on the advent now of getting these rate hikes essentially, and the clock is ticking. This is the March 22 contract we're trading, and we are due to get the rate hike cycle coming at the end of March. Now, we don't have any explicit readings out of Jerome Powell as to specific dates, but March has been mentioned on numerous occasions now. So the market is pricing that in. What the market is also, has priced that in. What the market is now pricing in is the potential for, and it's a very strong potential for 5 hikes this year. So, if we're on the dovish side of that, 0.225 per hike multiplied by 5, we're going to have an indicative of 1.25% Fed funds rate by the end of the year. And that's a paradigm shift from where we've come from, essentially in a low rates environment for quite some time, and the entire duration of this chart that you're looking at here on the daily. So yeah, it would suit that we come back to earth here. Probably, no one wants to hear me say this, but 3800 is on the Dow. 800 on the Dow. I could see that happen before we trade out on this March contract, and the faster we can get the dip over with, the mega dip, the faster we can start to get long this contract, and feel a bit more secure in holding our longs. Anyway, I'm digressing here. We do have this lovely line in the sand. You'll see on the hourly chart here. You're really going to have to be fast and working off on your longs, and leaning on the shorts now a little bit more. Looking at the SPOs. Well, really, before I go into the SPOs, if we look at these three markets in the center, you can see they're all really coiling up into quite a tight range these last couple of days, right? You can see that clearly here. And so I think we need to hear about these PCE pieces of data before the market can take any sort of a direction. For me, it's more downside. It's more downside. This is heavy. I do know a couple of portfolio managers who, especially on Twitter, they're just loading up the boats on these low prices. But let's see how that goes for them, and I do hope it turns out right. But a breach really of, say on the Nasdaq here, we'll go over on the daily. A breach of this 13,869s, needless to say, is going to be pretty violent. A breakdown here, really the next level of support is down on the 13,477s, and that's the low of the 3rd of June. But really, I don't see that being the breaks here. I think this is going to be the ultimate spot, 12,939s. But we will have to track the 13,453s. Now, am I looking for the 12,939s to trade today? Absolutely not. Um, could we trade on the 453s? Yeah, that's within possibility in my estimation. The breakdown around the S1 today basically is something I'm going to be looking out for on Nasdaq and SPOs. There's quite a bit to cover today. I mean, for the SPOs, it's very similar to what I've just covered there before I move on to commodities. But here is the SPOs on the weekly bars, because really it gets kind of messy looking at it otherwise. But lovely action this week off of the 4209s. The dip is bought. We are holding above the 50 weekly exponential average here. So yeah, I mean, there is food for the buyers here for sure, and get a bit, lift up off of this dip, but longs for the brave. And if we have strong prices coming through on these PCE index and deflators, that's indicative that inflation is getting entrenched, and real prices, what's getting charged in your supermarket basket, and all that is rising. And we then, therefore, when it comes to NFP, you really have to be looking at the average hourly earnings, and you have to see that rising. If inflation is rising, if cost of goods essentially is rising, well, people, you need to be making more money to afford that. Otherwise, you're in a pretty dire situation. So, ultimately, the Fed need to put the brakes on this inflation now, and that's why you're hearing about potentially 5 hikes this year. Jerome, and I quote, said he could do it. They could raise rates at every meeting. All right, so that translates to five. It's not like 11 more meetings, and they're gonna raise in each meeting, in that sense. But now you're starting to see how I'm thinking about this going forward. So next NFP, if we don't have a rise in the average hourly earnings, I'm going to be looking on the short side on that day and going forward. So we need the injection of the dip buying here. I think today, if we have relatively benign inflation figures out of PCE, I think we can bounce here. I think half of the world is buying this dip. Sophisticated money is definitely buying this dip, and so I think it's going to be hard to sell down on that sort of money. But sure, if we do, look for the break on the 4209s, and we're going to have a really bad day on the spoos to finish out what is a pretty crappy week now, to be honest. All right, let's move on. Nat gas, you'll see on the bottom left of my screen. Well, actually, you can't see it now because my head is in the way, but I'll bring up the daily. And what a day we had up yesterday on the Henry Hub gas contract. There was a bit of rolling of contracts going on here, but 10%, 10.7% up yesterday on that gas. A big old day. I was on the longs just before I finished off the session, as the traders in our room know. Didn't actually hold it long enough because it kind of died down a little bit, and I just got out. But really, I do want to be net long this contract now, and I'm going to be trading this a lot more over the coming weeks. Why is that? Well, I'll do a separate video discussing the natural gas risk that there is generally now in a global sense, with the situation, rising tensions in Ukraine. Now, the Russian Navy have ships docking off of the coast of west coast of Ireland. So Vlad, Mr. Putin seems quite set to have a pincer movement put on Europe while he has his way with the Ukraine. So that's what it's shaping up and looking like. But with that, long story short, if there's sanctions put on Vladimir Putin by the U.S., or any retaliation really from NATO to an invasion on the Ukraine, that's going to Putin is going to basically restrict gas supplies then into Europe. Thus, where are we going to get our gas from? Well, we could look to Kuwait, but really, we're first port of call for the Europeans is for our big brother Joe Biden, a good local lad from Ireland, and to ship out some gas to us in Ireland, and I suppose he'll have to give some to the rest of Europe. But with that, you're going to see a big pressing demand on Henry Hub natural gas. And this contract here, $5, forget about $5. $6, forget about $6. We're gonna really rip on this thing, and you got to price in for $7 here really, and that's going to happen very very quickly. If we do get an invasion, I think you're going to definitely have to price in $5.50 if we get the invasion, and then once you have a confirmed retaliation using gas as that tool, you're going to be looking at like $7 on natural gas here, easy peasy. So that's why it's on my radar. Trading oil, trading nat gas. Oil's holding on here, but the one thing that you need to be aware of is the correlation effect from equities to oil. Now, oil has done a great job this week in breaking free of that somewhat, but you have to really, if we go back in the 60 minutes here, you'll see when we came in on Monday, we had this really terrible time here where oil was looking quite weak below the trend coming in here at S3 today, this mega green trend here, right? So this is the market was weak, and it really got dragged down with equities, downside pressure on Monday on equities, but really nice recovery out of that. And so, while the downside pressure has remained on equities, you've seen oil, especially on Tuesday, just really lift on up here out of this area. There was this gap zone that occurred on overnight trade Thursday to Friday. Still tracking it because I still, I do see these levels become relevant on retests, as you can see here on Tuesday evening, for example. So we're going to track that area. Obviously, the trend is the uber important point here. We did have a bit of selling down yesterday, which definitely was bought up. The pullback on the 86.80s here, and quite a few of us on the team were buying that, but you can see it just couldn't lift and put in the new highs we were looking for here. So more pressure came down and just scrubbed it into the close there. So 86.80s again supportive this morning through APAC again now in this late session here. But for me, this level is really getting washed out. So another reason why you should be long oil now is, if you haven't got enough already, is that there is going to be a certain disruption of the OPEC plus quotas should Ukraine get invaded by Russia. OPEC Plus are part of the quotas of 400,000 barrels a day being put back online each month by OPEC. Is Vladimir and Energy Minister Novak, are they going to give a damn about those quotas when they're invading Iraq? They're not. They're actually going to tighten up and keep at home a lot of their indigenous supply, and they're not going to be able to meet their quota. I don't think at all. Now, you could argue that they do love to produce at maximum and sell as much as they can all the time, and history would certainly tell you that. But I would err on the side of caution and say, you know what, I don't think they're going to care while they're getting some global war game business done, right? So, that's why I think we can really get on up here in oil. Not to mention the demand increase that you're going to get when a lot of these countries will have to mobilize units on a global scale. Never mind naval ships. You're talking about, obviously warcraft carriers, fighter carriers. You're talking about multiple jets in the air, hundreds of jets from multiple countries in the air. UK British Air Force is already running exercises, as I was noting this morning, just on the borders there with Ukraine. So it's already lifting into quite a risky situation here. So that doesn't mean we could have some downside initially. If you look at the price inflections, for example, and I'll leave it on this, the price inflections when the Gulf War occurred, there was an initial crazy bid into oil that got completely unwound within about 24 hours. Um, or 48 hours, I should say. So, you have to be really careful here. And if you start seeing mega volatility, 9 times out of 10, if you're not on the trade and on side, you're better off staying away, really. So, and just, waiting for that market to settle down a bit. Um, Anything else? Gold. Look, gold is getting completely hammered on this downside. Um, the upside we're seeing on the dollar. So you really, when you're looking at the gold contract, which we've rolled today, by the way, volume was rolled to the J22. That's the April 2022 contract. You should update your charts if you're trading futures front months. So it's really getting hammered by this stronger dollar, and the dollar has a lot more to go. So we do have a trend here in gold, but it's. I don't think it's going to be the support we need to get into a nice trade here. Just let me update my chart and let's see, update some drawings here, which are pretty much. There's not much of a differential in the contract, um, in the new contract. So yeah, I think we can actually breach this trend that we've had here for some time. But here's another version of that trend on the downside. So 1785s, you may have some temporary buyers here, but I don't think I'd be sitting in there with limit orders. Okay, that's it for me for this morning. Guys, I'll see you in the Discord room at 1 o'clock. And for everybody else watching on YouTube, hope this was informational and informative, and I'll see you soon. All right, remember, only take the good trades, don't touch the bad ones. I'll see you later.